Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, we are going to talk about this chart that portends. When you first see the chart, you're thinking, oh my gosh, there's got to be a housing crash coming. This is way, way worse. It's 3 times worse than the housing bubble of 2006. Here is the tweet, the chart. This thing got like, I don't have the number on here, but it got tons of views, like 160,000 views, okay? U.S. homeowners have $34 trillion in equity with a tur, okay? Not with an M or a B, but with a trillion. That's almost triple the levels in the 2006 bubble. So that's the first thing, is he compares it to the bubble. Mm-hmm. He doesn't say 2006, but he says the 2006 bubble. It's a percent of GDP. It's the most housing wealth homeowners in the U.S. ever has. So now what he's doing is he's comparing GDP, 6 the most per GDP. So what he's trying to do is he's trying to make these comparisons to like, oh my gosh, this is like, we've never seen this. It'd be like Trump, like nobody's ever seen this before. They're talking about, we would never thought we would see this, and here it is. This is the most anybody's ever seen.
Is it big and beautiful?
Juana, first of all, why is equity? Why is homeowner equity? What are factors that make up homeowner equity?
Well, so you have equity when the amount, the value of the home supersedes what you owe on the home. So let's say that your home is worth $1 million and you owe $200,000, then your equity is $800,000. But let's say that your home is worth $1 million and you don't owe anything, then your equity is the full $1 million.
Okay, so that's one way. Mm-hmm. Can the home prices go up or are they fixed?
Home prices are not fixed.
Oh, they're not.
Home prices are set by what a buyer is willing to pay and a seller is willing to accept.
Market forces.
Yes.
Okay. What about if since this is the total value of homes, can we add to the amount, or if we add a house, do we have to destroy a house?
So we do add to the total value of homes by, to your point, building homes. So let's say that this year we have 100 homes and then next year we build 2 homes. So now we have 102 homes. And if all you're measuring is the value of homes, then naturally the value of all the real estate goes up. So it goes up both through appreciation. That means that something is worth more today than it was in the past. And it also goes up through adding inventory to the total housing stock.
One of the other things that's done with this chart, now this is just actually a Fred chart. If you actually went back and changed this to 2012, because what you've got is you've got most of the half of the chart where it's so low it looks like it's zero. And this is a visual trick to make a chart look worse. When I was a lot of you know I spent a couple years in grad school studying graduate level economics and business. And we talked about this, like how to present something to make it look a specific way. Literally, that was like a class that we took in grad school. And what they do in this chart is they scale it in such a way. If you went back and looked, if you went on the Fred website and took this chart and just took 2012 to today, it wouldn't look that ridiculous. It would actually look like it's just going up kind of normal. Now, Juana, let's talk about 2 things here. One is the value should go up every year, right? The total value of all homes should go up every year.
The total value of the housing stock does go up every year because you're adding housing stock every year.
Okay, there was a period where it didn't go up, 2006 to basically 2011.
Yes.
Because home prices tanked pretty hard and home builders basically stopped building homes.
Correct.
So we weren't adding any more homes, home prices were falling. And then the opposite, of course, has happened here. So you should see home values continue to go up, and you should see more homes continue to be built. So, and that doesn't mean home prices go up every single year, but what that means is over time, if I were to go 10 years from now, this chart's going to look even more so than it does today. Because in 10 years, we're going to have 8 to 10 million more homes, and then the homes are all going to be worth 30, 40% more, and then this chart's going to be even more vertical. What was funny was I went through the comments, and the comments were one of 2 things. Half the comments were, oh my God, 50% correction. Like this is Bitcoin or some Tesla in the stock market, right? Like it's going to correct because, some hedge fund came in and bought all the houses and spiked the prices. This has taken over a decade. It took 13 years to get from 2012 to today. So this is not like a spike that could just correct tomorrow. But what was funny was one of the comments I read was this guy, monetary commentary is his. Say that 3 times fast. It is it's just the name of his thing. It says, this is why housing volumes can collapse while prices don't. So the number of homes sold can go down, but the home prices don't necessarily collapse. And this is what he said in the tweet. You can't get a 2008 style crash when most homeowners are sitting on a mountain of untapped wealth and locked into a 3% mortgage. It was cool. There were actually a couple people also saying, hey, wait a minute. One of the guys even, I don't have the tweet, but he even asked, because this is like one of the big this is the godfather of the Crash Bros. He's like Marlon Brando, but for Crash Bros. And he said, but wait a minute. So what is the ratio of wealth to actual what's owned, or what's owed, like mortgages? And guess what the answer was from the Crash Bro himself?
No, I don't know.
30%. So what this means is, if you took all the real estate out there, the value of all mortgages is only 30%. So there's almost the percentage of mortgage debt on the housing market is a percentage, is not only the lowest it's ever been, it's financed at the lowest interest rate it's ever been. So all the people that are talking about housing crashes do not take this into account. What happens when you're sitting on a ton of equity in your house and you have a super low mortgage rate, or you're like 40% of people that own it free and clear because you have a bunch of rentals, you manage a bunch of rentals for like people who have lots of rentals. What are they saying? Like, why are they not freaking out and wanting to dump all their rentals because they think housing market may crash?
Well, it doesn't make any sense. I mean, the housing market can't crash because people have so much equity, so they can't be in distress and lose money on the deal. So you're not going to see short sales, you're not going to see foreclosures, you're not going to see these distress sales because people have equity. That's kind of where we started the conversation.
Even in some markets because there are markets in the US, we'll do the next video on this. We've got all the data because we got most of the markets are up year over year. We've got some that are down year over year. We'll talk about those. Even though those markets where it's down, if you have a 3% rate, do you really care? Like here's the thing, let's use Vegas example. If you're paying $1,500 a month on your mortgage, and that to rent the same house, the house next door is renting for $2,200, do you really care what your house is worth?
No, because the people who are payment sensitive, that's the point. They're payment sensitive, right? So if their mortgage payment is less, or to your point, considerably less than a rent payment would be for a similar home, then they're going to stay put and they're going to do whatever they can to hang on to this home.
If you knew, let's say you're 30 years old, and you knew you could never sell the house and get any equity, but you would only pay $1,500 a month on that house for the next 25 or 30 years. But if you rented, you would have to pay $2,200, and then every year have that rent go up $50 to $100 a year for the next, however long you're going to live, 50 more years. Would you care what the value of the house is?
No, because the value of the house only matters twice: when you buy it and when you sell it. Everything in between is noise.
So what you're saying is that having too much wealth is not going to cause the housing market to crash.
Having equity in the homes is what keeps prices stable at the worst and continues to help prices go up because people don't have that economic pressure to have to sell the property.
I'm going to put the chart back up. He does not specifically say housing crash, but he infers when he says that's almost triple the levels in the 2006 bubble. So he uses the word bubble to make you think that this is a bubble too. And then, if that was a bubble and we're because I see all these things now with AI, like, these AI stocks, this compares to the 2000 dot-com bubble, right? And then he compares it to GDP. It's like the highest percentage of GDP, because that apparently means it's out of the norm of what it should be. But we've talked about this. GDP only goes up at 2-3% a year in good years, right? Housing goes up at 4 or 5% per year, and they build more houses every year. Housing every year for the next 50 years should be, the amount of equity should be a higher percentage than the GDP every single year, because it goes up at a higher rate. Mm-hmm. So what he's done is he's taken these things that are knowns and he made them seem like a big deal.
He's also taken things that are unrelated.
Okay, explain that.
And that's really kind of the issue. Okay, so kind of you were making the point between the AI and the .com.
Right.
Okay, well, they seem similar because they're both technology related, but that's kind of where the similarities end.
Right.
I mean, they're completely different value propositions. They have completely different trajectories as far as the value that they bring to the enterprise and to the variety of businesses that benefit from it. It's a completely different thing. It's like comparing vegetables and fruits. They're not in the same family.
Right.
Okay, and that's kind of what this is like. Just because something grows and it's not an animal doesn't make it a vegetable and doesn't make it a fruit. It can be completely different.
Right.
And it's the same thing with this. And then, all of these different statements that are being made throughout all of this, they're using trigger words to elicit an emotional response that's not based on data or solid information. They're just looking for an emotional response, which an emotional response to a financial situation is definitely what you don't want to have. Okay, right. You want to have something that is data driven, that is intelligence driven, but not emotion driven.
What's interesting is when this guy goes on TV, he will always he'll find the worst market, like the market with the biggest year-over-year price decline. And that's the one he'll provide the graphics for. Like, oh, look at this one, Tampa or St. Petersburg or Austin or whatever, or some place in Florida or Texas or Louisiana. And he'll go, see this one market? Like, I'm just going to pull a random market up. Oh, look what I found. This is a random market.
Okay, but you know why? For the same reason that people rubberneck at car crashes. It has nothing to do with them.
Yeah.
But everybody rubbernecks at a car crash. And that's what he is. He's a car crash. And everybody wants to look.
I agree.
So, sorry, but that's my sentiment.
Yeah.
Any other charts or anything fun?
No.
All right.
This was fun.
Okay, well, Todd enjoyed himself thoroughly, and I hope you did too. Please remember to like the video, subscribe, hit the notification bell, share the video, and leave us your real estate-related comments. If you know the crash bro to whom Todd is referring, please let us know in the comments. It's always fun to know.
His name has been on the screen the whole time.
Okay, well, there you go.
I didn't black it out.
Okay.
They all know who he is.
See, I don't know.
He's monetizing his crash broness.
Okay, well, you're helping him monetize that.
I know, but I don't really care. I just think it's,
All right, we'll see you guys on the next video. Bye.
Bye.